friends, it's Angie. Welcome back to UK Money Wisdom. We're trying to make the complicated world of pensions and money a little simpler, clearer and fairer for every older person in this country. Today I'd like to talk about the new rules that many pensioners don't know about for 2025. And because I'm recording this in mid-November 25, just before the autumn budget on the 26th of November, I'm going to show you what has already changed for pensioners in 2025 and what this government is widely expected to change next, especially those hidden tax rises that could hit pensioners hardest as set out by the Institute for Fiscal Studies. Some of these rules will surprise you, some might worry you, and some could put extra money in your pocket if you act quickly and get what you're entitled to. So stay with me right to the end, because the final section is about a change that could quietly raise your council tax and other local charges without most people realising. Oh, a quick note before we start. This video is for information, not personal financial advice, so always double check your own numbers on gov.uk, and if you can, speak to a regulated advisor for big decisions. Let's jump in. In section 1, let's look at the quiet tax rise hitting more pensioners every year. This is the big one. The silent tax rise that almost no pensioner thinks applies to them, namely frozen tax thresholds that we call fiscal drag, and what might happen here in the budget. The personal allowance, that's the amount you can have before paying income tax, is still frozen at £12,570 and is set to stay there until at least April 2028. Meanwhile, the full new state pension from April 25 is £230.25 per week, about £11,973. The full basic state pension is £176.45 per week, about £9,175 a year. Lots of you also have a small private or workplace pension on top. So, even though your headline tax rate hasn't gone up, more and more of your income dragged into tax. So what does this mean for pensioners? People who never paid tax in their lives are being pulled into income tax for the first time. A modest private pension on top of the state pension can push you over that £12,570 threshold very quickly if you have any other income. Think tanks now expect millions more people, including pensioners, to be paying tax purely because of this freeze, not because they're richer, and the government makes it feel like any pension increase is a pay rise, yet the government quietly, stealthily takes some of it back again in tax if your income exceeds the threshold. So what can you do right now? Check your total income for this tax year. That's your state pension, plus private pensions, plus work, plus savings interest. Check your tax code, especially if HMRC has suddenly changed it because of savings interest or pension income. If something feels wrong, you can ask HMRC to review it. Don't assume they always get it right, because they don't. Okay, let's examine what the autumn budget might do next. The pre-budget rumours say the Chancellor may, number one, extend the freeze even further, possibly towards 2030, pulling even more pensioners into tax. Number two, They keep saying we're not raising income tax rates while using this stealth method to raise billions. It's really immoral. For pensioners, that means no NI to cut, but more income tax to pay. In section 2, let's look at the state pension increase and the trap it creates. Because yes, the state pension has gone up again and is still protected by the triple lock, which means it rises by the highest of inflation earnings, or 2.5%. The government has promised to keep this for now. From the 6th of April 25, we know the full new state pension is £230.25 per week. The full basic state pension, £176.45 per week. And from April 2026, it's expected to rise again by about 4.8%, based mainly on wage growth. The catches? Catch 1. Not everyone gets the full amount. Your actual pension may be lower if you have missing NI years, were contracted out in the past, are on a mixed pension, that's the old plus new system post 2016, or have other income, or have other quirks from the pre-2016 system. Catch 2. Low-income pensioners can fall behind. Pension credit is supposed to help low-income pensioners keep up, but if your state pension rises, sometimes your pension credit top-up doesn't rise enough, and you end up no better off or even slightly worse in real terms. Catch 3. Higher pension, same tax threshold. Remember, the personal allowance is stuck at £12,570, but the state pension keeps rising. That means more of your pension income crosses the tax line, especially once you add any private pension or savings interest. Let's look at the autumn budget risk. Commentators are watching two things very closely. Number 1, whether the triple lock is quietly tweaked in future years, not this tax year, but in the forecasts. And 2, whether the Chancellor leans even more heavily on fiscal drag instead of touching tax rates. For you, that means bigger pension statements on paper, but not necessarily more money in your pocket after tax and bills. In section 3, we're going to look at national insurance, the cuts for workers and the pressure on pensioners. You might have heard that national insurance has been cut again for workers in 2025. Employers now pay lower NI on their wages than a couple of years ago. The government is also talking about further NI cuts in the budget, possibly taking the main rate even lower. But what about pensioners? Once you reach state pension age, you don't pay NI on your earnings, and that part hasn't changed. So when politicians say we're cutting NI to help working people, that doesn't directly help pensioners. However, every time they cut NI, the government loses revenue. That makes it more tempting to keep income tax thresholds frozen and tighten other taxes, which is more likely to push pensioners into paying tax. And governments are also more tempted to include things that do hit pensioners: income tax, council tax, and tax on savings and investments. Here's an important update on NI top-ups. I'm afraid that window has now been closed by the government. You could previously buy back to 2006-07 only until 5th of April 2025, with some grace if you registered before the deadline. From the 6th of April 2025 in most cases, you can only buy back the last 6 tax years. That's the normal rule again. So now the key action is check your state pension forecast on gov.uk. If it says you could still boost it by buying recent years, get proper guidance before paying a penny. Some years still add nothing, others add a lot. In section 4, we're going to look at pension credit and the 2025-26 rules you can't ignore. Because pension credit remains the single most powerful support for low-income pensioners, and it still opens the door to a whole package of extra help. Here are the key numbers. From April 2025, the standard minimum guarantee is £227.10 per week for a single person, or £346.60 per week for a couple. If your weekly income is below these levels, pension credit can top it up. And why does this matter so much? If you qualify for pension credit, even a small amount, you may also get extra help with council tax, warm home discount in many areas, support with rent or housing benefit, help with health costs, free TV licence if you're over 75 and on pension credit. Every year, hundreds of thousands of pensioners miss out on pension credit, worth up to around £3,500 each a year, because they assume they're not poor enough. The autumn budget preview suggests the Chancellor is very unlikely to boost pension credit generously, but may instead keep increases tight, focus help on very specific schemes while relying on tax changes to raise money elsewhere. So the big risk is the safety net doesn't rise as fast as prices and local taxes. In section 5, we're going to look at the next big change, which isn't a single law, it's a whole shift in the entire banking system. From new payments architecture to gradual upgrades. Because the big project, once called the new payments architecture, NPA, they do use grand words, has effectively been rolled into a broader programme now called Interbank Infrastructure Renewal. For us, it means faster, more reliable bank transfers, more automatic fraud checks on payments, good so far, banks sharing more data behind the scenes to spot scams, they say. You might notice extra "Are you sure?" messages. You might notice delays if the system thinks a payment looks suspicious. You might notice more confirmation of payee checks when you move money, because things will get tighter. And if you're not sure of how to use the system, it might penalise you for it. Okay, let's look at branch closures and banking hubs. I hope you looked at my previous video on how we all need a people's public bank, because branches are closing all the time. Our high street branches, for instance, they're still closing, such as Santander, Lloyds and others have all announced more closures in 2026. To replace them, we're seeing more shared banking hubs and tighter access to cash rules, which says banks must make sure communities still have some way to get cash and basic services. For pensioners, this means more digital, fewer counters, more pressure on you to bank online, even if you're not comfortable with it. and also new rules that say banks must help keep access to cash in your community. This is exactly why UK Money Wisdom exists, to walk you through these changes calmly so you don't get left behind or ripped off. Let's look at hidden help, benefits many pensioners still don't claim. We'll quickly run through these benefits because lots of pensioners still don't realise they might get these under today's rules. Number 1, council tax reduction. Each local council runs its own scheme. Many pensioners on low or modest incomes qualify, even if they own their own home. Number 2, warm home discount. Rules have changed several times. Some people who lost it in previous years may now qualify again, especially if they're on pension credit or certain low incomes. 3, housing benefit for pensioners. If you rent, even privately, and your income is low, you may get help with your rent. 4, attendance allowance. Still one of the most underclaimed benefits in the UK. And it is not means tested. It's based on your care and supervision needs, not your income or savings. So do look into this. And 5, there's free NHS help for older adults. Depending on your age and income, you may get free eye tests, help with your glasses, free prescriptions, help with dental costs, help with hearing and other aids. And more, you have to find these things out for yourselves. They're not automatic. Budget speculation is focusing on raising revenue, not huge giveaways. But there is talk of 1, tightening or retargeting some schemes and focusing more on means testing support. So now is a good time to check what you can claim under the current rules before any tweaks make it harder after the 26th of November. In section 7, we're going to look at tax on savings and investments, the quiet squeeze, because interest rates have been higher for a while. Savings interests and investment income are much more of a problem for tax now than a few years ago. More pensioners are now paying tax on savings accounts and fixed rate bonds. Premium bond wins, which are tax-free, but other prizes and accounts aren't. Dividends from shares and investment funds. Interest from money in building societies and easy access accounts. With the tax thresholds frozen and some allowances cut in recent years, HMRC is increasingly using bank and building society data to estimate your interest and changing your tax code to collect what they think you owe. They can be wrong, so do check on what they're doing with regard to your particular circumstances. Here's an autumn budget warning for savers. Pre-budget reports suggest that the Chancellor is looking at higher tax on dividends, which hits people with share portfolios and some investment funds. Possible changes to ISA rules, making things more complicated. A cap on pension salary sacrifice, NI savings. It's more of a worker issue, but it affects people still contributing heavily in their 50s and early 60s. For you, the key actions now are: list your savings and investments and check which ones are tax sheltered, for example ISAs, and which are not. Check your tax code if you have sizable savings. Don't panic sell, just make sure you know where the tax might land. In section 8, I'm going to tell you about the final hidden rule, local tax and charges creeping up. and it's the one almost nobody talks about on TV. While Westminster argues about income tax and NI, local councils are quietly raising council tax where they can, adding social care precepts, tweaking discounts and exemptions, including single-person discounts, and increasing charges for things like parking, care and local services. At the same time, budget chatter includes possible reforms to council tax or property-based taxes, more expectation that local government will raise money from homeowners and landlords. For pensioners living on fixed incomes, that can feel like a slow tightening of the screw, especially if your income is only just above the line to get help. So, those are the new rules and likely changes for 2025 that every pensioner needs to know. Some will help you, some will cost you, some will quietly catch you out if you're not prepared, especially the frozen tax thresholds, pension credit rules and tax on savings. Thank you as always for being here with me, because you deserve clarity, fairness and peace of mind, and UK Money Wisdom will keep fighting to give you exactly that. Take care. I'm Angie from UK Money Wisdom. I'll see you all again very soon. Bye for now.